Last session and topic is different measures of volatility such as EWMA, ARCH, and GARCH processes, volatility clusters, and the issue of time varying volatility and issue of time aggregation. Measures of volatility and time varying risk. Volatility concept. Volatility measures the degree of variations in asset returns over time. It is commonly measured using variance or standard deviations. Financial market exhibits changing non-constant volatility known as heteroscedasticity. The meaning of this word is variance of error. In this session, we will learn about the different types of market risk related to aggression. Okay. Now our question is that what are the future developments? Alignments of shareholders' value and risk management. Alignment of shareholder rules and risk management. The preceding three sections of this session have addressed in individual elements of creating and delivering shareholders value, the business risk continuum, the risk response or architecture. For some organizations, the ideas set out in this paper will be new, other will be well advanced in applying these principles and processes. There are the course also several points on the which advances are being made. Some of these are as below. Measurements. The identification and measurement of risk covers many professional disciplines, including engineering, actuarial, mathematics, and financial studies. And there are numerous linkages between these various professions and disciplines. International standards are emerging and are under development, and one of the many threads that draw the various interested parties together is quantitative methods. Current and future developments in quantitative methods fall into two broad categories. On the one hand, methodologies exist and will continue to be refined for the measurement of specific risk, both as to their likelihood and impact, while on the other hand, the aggregation of risk, sometimes using statistical method so as to determine an overall impact either on technical or commercial operations or cumulative to an overall effect on shareholders value. Means when you are learning in MBA finance, you should have knowledge about quantitative techniques also, means related to statistics. Measurement, the way forward, the determination of shareholder value by shareholder value analysis methodologies is quite well developed already and helps focus the risk management process on the value drivers that are keys for managing threats and opportunities. Shareholder value analysis easily provides a quantitative framework which can be used to evaluate the quantitative impact of possible risk scenarios. In most cases, risk impact will be related to the impact on future cash flow from operations But the shareholder value model will show that other drivers like financial structure, taxation, market outlooks, etc., are also of importance. Likelihoods of risk scenarios could be supported by historical and benchmarking information, but could, on the other hand, be assessed on a subjective basis to be able to predict them more reliably than historical data. Certainly, when new activities are commenced. Shareholder value models already include way of quantifying hazard opportunities and uncertainty in the way they quantify shareholders value. Shareholder value determinations uses assumptions on business risk, most commonly the risk premiums in calculating net present value depends on the industry. However, the area of managing risk is dealing with the company specific risk profile and is often not well understood by shareholders and investors. Work still has to be done on the relationship between the company risk profile and the common industry risk profile. The impact of risk management programs will be assessed in the future by assessing the impact of risk management activities on the company risk profile. The shareholder value model probably provides the framework for assessing this impact, which may be a more comprehensive way of assessing risk management activities than by quantifying impact and probability of each risk scenario. This may probably be done by assessing the changes in the probability distributions curve describing the possible future, that is cash flow, scenarios that are reflected in shareholder value calculations. Finally, information technology will do facilitate better processing of the building component of shareholders value, and another is generate further questions as more layers of the picture are revealed. A marketplace snapshot conference a more detailed review in the United States. COSO, the Committee of Sponsoring Organizations of the Tradeway Commission, engaged Coopers and Lebrun to carry out a study which was published in their final report, Internal Control Integrated Framework in 1992. The aim was to provide a definitive framework against which business can assess their control systems and determine how to improve them. The Costco cube represents how the internal control framework applies to all organizations, that is related to operations, financial reporting, and compliances. How it can be done? By monitoring information and communications, control activities, risk management, control environment in different unit from unit A to all, and all the activities will be carried out in this process. The Costco report concepts have been incorporated into regulations and professional standards in the United States, form a basic for cocoa in Canada, and the Cadbury guidance in the United Kingdom have been used by other countries, have been translated into the at least 8 foreign languages, have been adopted by academia, accepted by United States General Accounting Office, and serves as a control framework for hundreds of companies. Many people know minimum three languages, that is their regional language and national language and international language. But You should have to try to learn more languages from the different institutions, because if you want to learn or if you want to do a job in abroad, you must know the language of that country. Most of the people in Pune learns Japanese language, French language, and other languages for their future convenience. Or you can learn these courses online also. Our college also has a language lab. COSO was groundbreaking, and its strength can be measured by the ongoing relevance of the thinking embedded in the guidance. The Public Oversight Boards recommended V12 states the SEC should require registrants to include in a document containing the annual financial statements that are a, a report by managing on the effectiveness of the entity's internal control system related to financial reporting, and B, a report by registrant's independent accountant on the entity internal control system related to financial reporting. In the United Kingdom, the Cadbury Commission, the Committee on the Financial Aspects of Corporate Governance, chaired by Sir Adrian Cadbury, published a report in 1992. Cadbury requires that Director of Public Companies report on the effectiveness of their organization's internal controls, and the external auditors should review such statements of compliance. The Cadbury Code also encouraged enterprises to disclose specific key risks. Every company must have to do internal audit and external audit. For that, he must have to appoint a CA level or CFA level person. Or if you are doing this job under a CA, you can also perform internal audits, and external audits are always required from CA. Generally, accepted risk principles GARP, Coopers and Lebron developed an industry standard for risk management and internal control in 1996, known as Generally Accepted Risk Principles GARP. GARP provides a benchmark of risk management practices for those who manage and regulate trading, treasury, and investment activities in the financial markets. GARP maintains three types of activities, that are trading, treasury, and investment activities. Example, the reporting obligations of UK listed company changed as a result of the adoption of the Hampel Committee's Combined Code issued of June 1998. The Hampel Committee final report obliges an organizational directors to make statements to show how they apply the principle of the combined code, and another is comply with the combined code, which incorporates early work with Cadbury, Greenberry, and Hempel. The requirement does not mean more annual report details, but it does require a more in substance approach to risk management reporting. Additionally, the scope of the reporting requirement extends to require directors to at least annually conduct a review of the effectiveness of the group's system of internal controls. This will relate to all relevant control objectives and not merely financial controls. This should include business risk assessment and response, financial management, compliance with laws and regulations, and the safeguarding of assets, including minimizing the risk of frauds. Few employees always do frauds in the company or expected more money or easy money. But to work with honesty is the best nature of human being, and it gives a immense development to that person. So always work honestly in each organization, means keep yourself on the stage of the owner of that organizations, that you are also the part of that organizations, and you also have few responsibility develop that organizations. Financial reporting of risk. In 1998, the Institute of Chartered Accounts in England and Wales released its proposals that a statement of a business risk be included in the annual reports of publicity traded companies. The statement would identify and prioritize key risk, describe actions taken to manage each risk, and identify how risk is measured. The purpose of financial reporting of risk is not to burden business with voluminous new reporting, but to encourage the provision of quality information on business risk that will be of a real benefit to investors. The Royal Society of Arts. The Royal Society of Arts reports tomorrow's companies point out that only though depends relationship between employees, customers, supplier, investors, and the community will companies anticipate, innovate, and adopt fast enough while maintaining public confidence, because company always invest their money after checking your profile and your development only. Innovations and adoptions both for superior risk management. In Canada, the CICA Criteria of Control Committee (COCO) in 1995, the committee issued guidance for directors, governance, processes for control. This guidance poses many questions, including are major risk and opportunity identified and related control objectives set. Another question is that how are new risk opportunities and control requirements identified? Toronto Stock Exchange guidelines on corporate governance. Guidelines on the disclosure requirements of the Toronto Stock Exchange included in the Toronto Stock Exchange Company manual identify managing risk as one of the principal responsibilities of the board. The board must understand the principal risk of all aspects of the business in which the corporation is engaged, and recognizing that business decisions require the incurrent of risk, achieve a proper balance between the risk incurred and the potential returns to shareholders. This requires the board to ensure that there are in place systems which effectively monitor and manage those risks with a view to the long-term viability of the corporation. The Canadian Institute of Chartered Accountants CICA, SICA. In 1998, the SICA, through its criteria of control boards, issued a paper that is learning about risk, choices, connections, and competencies. This paper examines the nature of risk and offers some risk models and proposition about how risk identification and assessment may be addressed. The paper is the result of a program of wide-ranging literature research, interviews, and thinking over the past year. It contains material that will challenge conventional view, including strategic choices, operational risk and control choices, risk choices, resilience and survival choices, leadership choices, choosing to be aware, institution, and the choice of deny or act. The Conference Board of Canada. In 1997, the Conference Board of Canada issued a conceptual framework for integrated risk management auth- authored by Lucky Nottingham. The key message is that integrated risk management is a critical tool to steer organizations through turbulent and volatile environments. The conceptual model involves a framework for risk management, a top-down driven and supported risk management policy approach and processes, a champion or central coordination point, and last, organizations wide risk management processes. In another country, in the Netherlands, the Dutch Commission on Corporate Governance, known as the Commission Peters, has issued a report on corporate governance. Corporate governance in the Netherlands, 40 recommendations. Included in these recommendations is the requirements for the board of discuss the organization strategy and its risk, as well as the assessment of the internal control structure with the supervisory board. And Australia and New Zealand. Australia Stock Exchange in 1995, the Australian Stock Exchange ASX introduced a listing rule requiring all listed companies to provide statement of corporate governance practices in their annual report. The ASS responded to both local and international shareholder pressures and, among other things, required that the following be covered in the annual report. The board approach to identify area of significant business risk and putting argument in place to manage those risks. Standard Australia and Standard New Zealand 4360 is to 1995 is risk management. In late 1995 standard, just like our ISO standard that we use in India 2001, to different criteria are there to take these ISO standards for our products or company administrations. In late 1995 standards, Australia and Standard New Zealand issued Standard 4360 is to 1995 risk management. This sets out generic guidelines for the identification, analysis, assessment, treatment, and monitoring of risk. Although it is not mandatory, this standard has had wide recognition, particularly in the government sector, and has been considered as a possible basis for world guidance under the umbrella of the international organizations for standardization. In France, the Vionet report in 1995, the French Association of Private Companies, chaired by Marc Vionnet, head of Societe Generale, published a report called the Board of Public Companies. Among other things, the report expressed the new and the view that the board of directors should not simply aim to maximizing share values as in UK and the US. UK means United Kingdom, means Britain, and US means United States, that is America. Rather, its goal should be serve the company whose interest should be clearly distinguished from those of its shareholders, employee creditors, including the tax authorities, suppliers, and clients, but still equated with their general common interest, which is to safeguard the prosperity and continuity of the undertaking. Risk management processes would support the focus on prosperity and continuity. Every country is in this situation to control all the different types of risks. In yesterday's news, it is shown that US is trying to take command on all the small countries. In Italy, Riforma Draghi. In Italy, the proposal formulated from the Commission of the Ministry of the Treasury, President over by the Director General Processor Mario Draghi, also clarify the task of supervisory board, including observance of the laws and corporate characters, but also internal controls. And in South Africa, the King report, Marvian King, South Africa's leading authority on corporate governance and author of the 1995 King report, delivered to South Africa the equivalent of the Cadbury report in the United Kingdom. Enhanced disclosure will strengthen conformance. Measurement of management of risk. Value at risk, we are the concept of computations, testing, back testing, cash flow and risk, CR, VR and CR to make investment decisions, managing risk with measured by VAR or CAR, non-insurance methods of risk management, risk avoidance, loss control, risk retention, and risk transfer, asset liability management, ALM, evaluations and concept, RBI guidelines, capital adequacy, management of interest rate risk, liquidity risk, credit risk, and exchange rate risk. We have already seen about value at risk. That is, value at risk is a static that measures and quantifies the level of financial risk within a firm portfolio or position over a specific time frame. This metric is most commonly used by investment and commercial banks to determine the extent and occurrence ratio of potential losses in their institutional portfolios. Risk managers use VAR to measure and control the level of risk exposure. One can apply VAR calculation to specific positions or whole portfolio or to measures firm-wide risk exposure. understanding. VR modeling determines the potential loss in the entity being assessed and the probability of occurrence for the defined loss. One measures VR by assessing the amount of potential loss, the probability of occurrence for the amount of loss, and the time frame. For example, a financial firm may determine an asset has a 3% 1 month VAR of 2%, representing a 3% chance of the assets declining in value by 2% during 1 month time frame. The conversion of the 3% chance occurrence to a daily ratio placed the odds of a 2% loss at 1 day per month. Using a firm-wide VAR assessment allows for the determination of the cumulative risk from aggregated positions held by different trading desks and departments within the institutions. Using the data provided by VR modeling, financial institution can determine whether they have sufficient capital reserves in place to cover losses or whether higher than acceptable risks require them to reduce concentrated holdings. Example of problem with VR calculations. There is no standard protocol for statistics used to determine asset, portfolio, or firm-wide risk. For example, statistics pulled arbitrarily from a period of low volatility measure may understate the potential for risk events to occur and the magnitude to those events. Risk may be further understood using normal distributions probabilities, which rarely account for extreme or black swan events. Black swan. We have seen always white swan, but here is the concept about black swan. The financial crisis of 2008 that exposed these problems as relatively begin we are calculating understand the potential occurrence of risk events posed by portfolios of subprime mortgage. Risk magnitude was also underestimated, which resulted in extreme leverage ratios within subprime portfolios. As a result, the underestimation of occurrence and risk magnitude left institutions unable to cover billions of dollars in losses as subprime mortgage value collapsed. VAR, value at risk, is a static that measures and quantifies the level of financial risk within firm portfolio or position over a specific time frame. This metric is most commonly used by investment and commercial banks to determine extent and occurrence ratio of potential losses in their institutional portfolios. Investment banks commonly apply VR modeling to firm-wide risk due to the potential for independent trading risk to unintentionally expose the firm to highly correlated asset. Evaluating the frequency and severity of losses. After identifying loss exposures, a risk manager ideally would obtain information about the entire probability distributions of losses and how different risk management methods affect this distribution. We illustrate how larger firms might estimate the relevant loss distribution in these sessions. Frequently, risk managers are summary measures of probability distributions such as frequency and severity measures, as well as expected losses and the standard deviation of losses during a given period. These measures helps a risk managers assess the cost and benefits of loss control and retention versus insurance. We therefore illustrate how this summary measures can be obtained in practice. Frequency. The frequency of loss measures the number of losses in the given period of time. If historical data exists on a large number of exposures, then the probability of loss per exposure, the expected frequency per exposure, can be estimated by the number of losses divided by the number of exposures. For example, if Sharon Steel Corporation had 10,000 employees in each of the past 5 years, and over the 5 year period, there were 1,500 workers injured, then an estimate of the probability of the particular worker becoming injured would be 0.03% per year. 1,500 injuries and 50,000 employee years. When historical data do not exist for a firm, frequency of losses can be difficult to identify and quantify. In this case, industry data might be used, or an informed judgment would need to be made about the frequency of losses. Severity. The severity of loss measures the magnitude of loss per occurrence. One way to estimate expected severity to use the average severity of loss per occurrence during a historical period. If the 1,500 worker injured for Sharon Steel cost $3 million in total adjusted for inflation, then the expected severity of worker injuries would be estimated at $2,000, means dollar 30 lakhs divided by 1,500. That is, on average, each worker injury imposed a $2,000 loss on the firm. Again, due to the lack of historical data and the frequency of losses, adequate data may not be available to estimate precisely the expected severity per occurrence. With a little efforts, however, risk managers can estimate the range of possible loss severity, minimum and maximum loss for a given exposures. Why we need previous data every time? Means we can take the decision with the help of previous data whether to take insurance of all companies or not. Hmm? Because previous data help us in amount, that how much amount we spent on employee for the injuries, and how much risk will be there in future also. So how much insurance can we must have to sanction for our next employee. Expected loss and standard deviations. When the frequency of losses in uncorrelated with the severity of losses, the expected loss is simply the product of frequency and severity. Thus, the expected loss per exposure in our example can be estimated by taking expected loss severity per occurrence times the expected frequency per exposure. Expected loss obviously is an important element that affects business value and insurance pricing. Thus, accurate estimates of expected losses can help a manager determine whether insurance will increase firm value. Continuing with the Sharon Steel example, the annual expected loss per employee from worker injury is 0.03 into $2000 equal to $60 with 10,000 employees. The annual expected loss is 6 lakhs. Ideally, many firms also will estimate the standard deviation of losses for the total loss distribution or for losses in different size ranges. Suppose we invested $6 lakhs or as per Indian rupees. As an example, means we have invested 6 lakhs for the insurance of our employee. And what happened if there is a any unexpected occurrence or accident done by the calamity? What will be happen? It will be hammer to our operation systems due to the injuries. How means if employee has to pay near about 25 lakhs for their injuries and recovery, your loss will be up to 25 lakhs if you have not spent a amount of rupees 6 lakh for the insurance. Means from that 25 lakhs you can minus 6 lakhs, means there is a profit of 19 lakhs. 25 lakhs minus 6 lakhs, or you can take the example in dollar also. Dollar 25 lakhs minus dollar 6 lakhs. One way to summarize information about potential losses is to create a table for various types of exposures that are property, liability, etc. that provides characteristics of the probability distributions of losses for the particular type of exposure. An example for Sharon Steele's property exposures is provided below. To create an accurate recognition of a firm's loss exposures, considerable information, time and expertise are needed. For more companies, especially smaller ones and new ones, detailed data on loss exposures do not exist. Nevertheless, the framework of this table still can be used. For example, each type of exposure can be classified as having low, medium, or high frequency of severity. It provides an example for Penn Steel Corporation, a firm that is engaged in the same activities and is of the same size as Sharon Steel Corporation. Both show that the standard deviation of losses for high frequency loss, low severity losses is low, while the standard deviation is high for low frequency losses with high potential severity. This relationship is fairly general. Infrequent but potentially large losses are less predictable and pose greater risk than more frequent smaller losses. Using the type of information illustrated in these tables, firms pay particular attention to exposures that can produce potentially large disruptive losses either from a single event or from the accumulations of a number of smaller but still significant losses during a given period. Summary. The risk management process begins with risk identifications. Businesses typically identify their major property risk, liability risk, human resource risk, and risk arising from external economic events. Individuals typically identify their major earnings risk, expense risk, assets risk, and longevity risk. A probability distributions describes the possible outcome and the probabilities of those outcomes for a random variable. The expected value of probability distribution is the weighted average of the possible outcome, where the weights are probabilities. Standard deviations or variance is a measure of probable variations around the expected value of a probability distributions for a random variable and thus of the risk unpredictably of the variable. Skewness measures symmetry of the distributions. Many loss exposures have skewed probability distributions. Pooling, arrangement, and diversification of risk. It shows how pooling of independent loss exposures reduces risk. Show how correlation in losses affects the amount of risk that is reduced in the pooling arrangement. Discuss how pooling arrangement provides the foundation for insurance transactions and how insurance are efficient managers for pooling arrangements. And last, discuss other examples of diversification, including stock markets, risk reduction through pooling independence losses. The most important risk management concept may be diversifications of risk. Diversification is an essential aspect of insurance and financial markets. We analyze diversification in these sessions, highlighting the sector factors influencing the extent to which risk can be and is diversified. We illustrate diversification in several different contexts, beginning with a simple pooling arrangement between two people and ending with a diversification among thousands of people or business through insurance and financial markets. Using the probability and statistics concepts reviewed in the previous sessions, we can now explain how pooling managements reduce risk when losses are independent or uncorrelated. Two-person pooling arrangements. Suppose that Emily and Samantha each are exposed to the possibility of an accident in the coming year. In particular, assume that each person has a 20% chance of an accident that will cause a loss of dollar 2,500 and an 80% chance of no accident or no loss. The probability distributions for accident losses for each woman is summarized in this session. Note that the distribution is very skewed. That is, there is high probability of zero loss and a much smaller probability of a large loss. Also assume that Emily's and Samantha's accident losses are uncorrelated. We want to examine what will happen if Emily and Samantha agree to split evenly any accident cost that the two might incur. That is, they agree to share losses equally, each paying the average loss. This arrangement often is called a pooling arrangement or a risk pooling arrangement because Emily and Samantha are pooling their resources to pay the accident cost that may occur. Because Emily and Samantha each have a 20% chance of having an accident that causes $2,500 in losses. The expected cost and the standard deviation for each person without a pooling arrangement means if we know the chances are only 20%, but we should have to we should do not have to take risk. Need for advanced volatility models. Traditional volatility measures assume constant variance, which is unrealistic because large price changes tends to cluster together. Market shocks affects volatility over time. Market shocks means unexpected big losses. Risk changes with market conditions. Hence, models like EWMA, ARCH, and GARCH are used. We will see what are these abbreviations are or terms. EWMA means exponentially weighted moving average. These concepts EWMA assigns more weight to recent observations and less weight to older data when estimating volatility. Formula is given for that, how to estimate the volatility. Feature of this EWMA. Features captures time varying volatility. No need to estimate many parameters. Used in risk metrics. Limitations are also there. Assume symmetry response to shocks. No long-term mean reversion. Only short-term mean reversion is used in this term. Next term is ARCH, ARCH, autoregressive conditional heteroscedasticity. Heteroscedasticity means variance error. Model concept. Arch model assume that current volatility depends on past squared returns, capturing volatility clustering. Arch 1 model formula is given. You will get this formula. Advantages of this term is model volatility clustering and allow variance to change over time. And their limitations are require many logs to capture persistence or parameterizations. GARCH means GRCH, generalized autoregressive conditional heteroscedasticity. GARCH extends ARCH by including lagged conditional variance, making it more efficient. Formula is given of this model and their features is capture long-term volatility persistence, requires fewer parameters, widely used in finance. Volatility clustering, meaning periods of high volatility are followed by high volatility. Periods of low volatility are followed by low volatility. Large shocks tends to cluster in time. Why we are clustering? Because when we purchase raw material, when we purchase uh, packaging tools for our products, we have to cluster all these expenses for volatility measurements. This explains why volatility is predictable even though returns are not. Time varying volatility issues. Volatility is not constant over time, influenced by economic events, financial crisis, policy changes. Implications. Model assuming constant variance are misleading. Arch, Garch, and EWMA are preferred. Issue of time aggression. Concepts. Time aggression refers to covering volatility from one time period to another, daily to monthly. Limitation of time aggressions. Valid only if returns are independent, identically distributed. Fails when volatility is time varying, not accurate during market stress. And its comparison is given. Comparison of volatility models. EWMA, Arch, and GARCH. That are exponentially weighted moving average, auto-regressive conditional heteroscedasticity, and generalized auto-regressive conditional heteroscedasticity. Practical importance essential for where estimation used in option pricing help regulators and portfolio managers manage risk. And thank you. Today's session is over.